5 minutes and counting, guys. 5 minutes and counting. Okay, well, good morning, Checkmate crew. It's 30 minutes after the opening bell of New York Stock Exchange at 10 a.m. Eastern Time on this beautiful Wednesday morning, January 11th, 2023. Yours truly, Mickey Blindside here with your market memo. Okay, guys, so it looks like we gapped up in morning trade today. Looks like all the indices are up. The VIX, surprisingly, also up. So that thesis that we've had since I mean, really in the summer, we've been anticipating this. I said, toward the end of the year, beginning of the year 2023, end of year 2022, we were probably going to see episodes of higher VIX movements as hedging demand comes back for not so large movements in the S&P 500. So that thesis is still playing out. All right. Tomorrow we have the US CPI data. It is expected to be coming out lower than people are expecting lower disinflationary prints on this US CPI. And again, we here at Checkmate Trading, we've been anticipating this since the summertime when we saw the peak in TIP TLT. Now, just because somebody posted something on our Discord, something on Twitter about how one of the investment banks, I think it's JP Morgan or Goldman Sachs, it's one of those, they said that if the CPI comes in under 6.3% or something like that, we're going to rally like 2 or 3%. Well, I'm not so sure about that now. These investment banks, they're not your friend. The fact that they released that to Bloomberg and to the other news outlets pretty much means, it doesn't mean that that's how they're positioned. And by the way, I don't know if you guys know how big banks work, but what they usually tell to their media versus what they tell to their best clients is usually very different. It's usually different divisions in the company. Their reasoning for that and how they get away with it is they say, well, we have independent departments and they all have a range of views, and isn't it a good thing that you get access to all these wide range of views if you work with our company? That's kind of the selling point of why they have multiple views in different departments, but really it's to cover their behind ends just in case if something doesn't work out. And so the division that usually reports to the media, what they say and versus what they tell their top clients, very different. Okay. And so right now, the reason why I do think that even if a lower CPI print, we could see, I'm not trying to predict the future. Okay. We could rally. Okay. I'm not saying that we can't, but it could be that we're already positioned for that disinflation CPI report. One of the things that makes me say that is actually, is the interest rate inversion, yield inversion trade right now. Okay, there's a big trade right now, and it's just people are piling onto this. The hedge funds right now are piling into this trade where they are shorting the shorter dated treasury bonds, treasury bills and notes. They're shorting the shorter dated maturities, and they're going long the longer maturities. Okay, so so a lot of hedge funds are betting on the inversion increasing. Okay, so basically what they're really betting on is that there's going to be a recession. Okay. There's going to be a recession, and then Powell is going to come around and save the day and cut interest rates. Okay, that is the big bet right now, and it's being piled on. It's already kind of crowded, but it can get even more crowded. Okay, and I do think that at some point that trade is going to blow up in people's faces. Okay. I don't see any signs that we're going to see a recession anytime soon. And with all this, that trade in it by itself, where you're betting on the inversion increasing, okay, so, the shorter dated yields are going to go up and the longer dated yields are going to come down, betting on that actually expands credit. It makes credit cheaper. It makes that longer dated debt cheaper to obtain. If you think about it, most of the debt that that companies or consumers get are longer term debts. And so this actually expands credit. It's actually also expanding credit on the junk market as well, in corporate credit, okay? So I think this yield inversion trade is actually expanding junk corporate credit as well too, and then that's evident by the junk bonds ADL, or junk bonds advanced decline line. By the way, our junk bonds advanced decline line came up 10 issues short. We needed a plus 42 in order to make a higher high from the December highs. We were plus 31 yesterday, so we're 11 shy of making a higher high, okay? So it's not a higher high yet unless it is, okay? So we have not gotten the higher high yet, but I do think that right now we're seeing a lot of strength actually in the corporate credit market, and I think a lot of that has to do with this inversion trade. So, something that I've noticed that in the futures positioning, as well as some of the bond trades that I looked over, a lot of these institutions are betting on that inversion increasing, and then there's going to be a recession, and then Powell's going to come out and then do some rate cuts. Well, here's the thing. If corporate credit keeps expanding from now until, let's say, mid to end of year, there would really be no incentive for Powell then to cut rates. Oh, but wait, Mickey, didn't you say that there was going to be a pivot? Well, yes, the pivot already happened. The messaging has already changed. Back in November, December, the Fed and Powell changed their tune. They kept using the word moderation and moderation. Moderation is a dovish word, okay? It's not a hawkish word at all. Moderation is a very dovish word. So, and again, there's three ways that the Fed can affect monetary policy. They can either use interest rates, they can use their balance sheet, or messaging. And out of the three, it is argued that messaging is the most powerful weapon that the Fed has. So they've already pivoted. That's a done deal. We were right in saying that they were going to pivot once they see that CPI drop, which it did in November. Pivot doesn't mean that they have to cut rates, okay? That's not what, at least for me, that's not what a pivot means. A pivot just means that, it's a change in trajectory. So they've already changed their direct trajectory. They're already implementing rate hikes that are smaller than ones they were doing over the summer. All right. So they've decreased the rate of rate hikes, and also their messaging has gotten less hawkish. Now, if this inversion trade just keeps going and people keep piling onto this, then it's going to expand credit. Well, then what do you think he's going to do in mid to late 2023? I don't know. I don't know the answer to that, but I don't know if this market that's pricing in this rate cut at the end of the year, I don't know if that's going to happen. But right now, currently, the Fed funds futures market is anticipating at least that our top nominal rate is going to get to about 5% on the Fed funds rate, 475, 500, and then around November or so, it's the chance of a 25 basis point rate cut is in play. Potentially another one in December. Okay. Now, will that happen? Will that not? I don't know. But right now, it is getting very, very crowded as a trade, and that might unwind. And when that unwinds, we might see some volatility re-enter the market as the longer dated yields, like the 10-year and the 20 and so forth, that the yields start climbing on that and affects valuations. Okay. As we saw last summer in 2022, when we saw that interest rate volatility, we saw a lot of institutional bids just disappear because institutions cannot judge fair value if interest rates are moving so much. Okay. We might see something like that. I think it might actually happen around April. If you look back at history, especially recent history, we've noticed that there's been a lot of bond market activity around tax time, around tax paying season, around April. One of those reasons is because when you pay public debt, which taxes is a public debt. Whenever you pay a public debt, it has to be paid in dollars. It's one of the legal tender laws here in the United States. When you pay taxes to the IRS, the only form of payment that they will take is US dollars. Okay, and so we might we might be seeing some volatility around that, and generally we do. If volatility does enter into the market, usually we see it in the bond market around April or so. So perhaps that might be the impetus for the unwind of that trade. But from now until then, we could just keep piling on into that inversion trade. And so right now, again, the market is pricing in that there's going to be disinflation, there's going to be a recession, and then there's going to be rate cuts. Okay, the market is already very crowded in that, and it's getting even more crowded. I think it keeps getting more and more crowded, probably until April or so, and then maybe we see a wave of volatility happening again after that. I'm just thinking 5 to 10 moves ahead right now, but that's just what I see, just based on because what I asked myself was, why is corporate credit breadth so strong? Why is corporate credit so strong? And so that led me down this rabbit hole, and I think that's the best explanation that I can come up with is, as we're going through QT, quantitative tightening, how is it that the bond markets are so the junk bond market is so resilient? And I think it's because of that inversion trade. It's actually expanding credit at the moment. Okay, so we'll see. All right, now if this continues, if this trend continues where junk bonds, ADL makes that higher high, higher low, all of our liquidity data like the New York Stock Exchange high-low line, which by the way is almost to that last moving average, so it is going up, by the way. If these two are curling up and make higher highs, higher lows, definitely I'm going to be looking to buy the dip on IWM or QQQ, and I think for the next few weeks we might see outperformance in IWM and the QQQ over the other indices. Right now, small caps is up around 0.75%. QQQ is up 0.7%, and SPY is up 0.53. So we're already starting to see some type of that outperformance in growth stocks. If we look at the IVW IVE chart, which is the growth ETF divided by the value ETF, it's still in a downtrend, and we might see this downtrend reverse if we start seeing that bid come back into growth stocks. And I think it does. I think a lot of that will actually start coming in after the third week of January. That's when the 30-day wash sale rule period is over, after much of the bulk selling, tax selling that happened in December. So I do think that a lot of the institutional bid may come in around there too, but then we might see some actual sector rotation around February, March, as some of these industrial names, they around end of February, early March of 2022, we saw a lot of institutional block buying in industrial names. That 1 year period comes up in the end of February, early March of this year, which means that those who invested and profited in those industrial stocks, they can now pay the lower capital gains tax rate over income tax rate. So they might take some profits, but that profits will have to find a new home, and we might see that rotation happening back into tech around that time, March, April, or around, actually end of February, early March. And that's probably when we might see this inversion trade come up in the headlines or something like that. So that's kind of the progression of what I see for the next 3 or 4 months. First, a little bit of strength from the growth in small caps, and then most likely, as that yield inversion trade unwinds and some of the longer dated maturities, the yields start going up, well, that might also compress valuations. So we might be seeing this kind of big rally and just a big a drop sometime, in the next, let's say, quarter or two, that creates this kind of longer term sideways action on the indices. That's very, very possible. And that's actually one of the characteristics of a rolling bull market. Sometimes in a rolling bull market, you might see an upward drift, but sometimes you also see this sideways consolidation that lasts for months on end as, one sector rallies some of the other sectors fall, and it's very uncorrelated markets. Okay, so sometimes, like in 2017 when we had the rolling bear market, we had an upward drift, but it doesn't always have to be like that. Sometimes it could just be a sideways band. Either way, we're going to see how that all plays out. And again, I'm not going to make a move until our liquidity signals go into an upward trend. The junk bonds ADL line is closer to making that upward trend than the New York New York Stock Exchange high-low line. But, again, we'll see. I think it still is maybe like at least a couple weeks away from an uptrend. But if this gets into an uptrend, then we could see a meaningful rally that lasts a few months. We haven't seen this at all since 2021. So this will be a change in an environment, in the market environment going forward. This will be a pretty big change. Again, we haven't seen this at all in 2022. Again, last time we saw this was around November, December of 2021. The New York Stock Exchange advanced decline line is actually making a higher high. So the market breadth, or how many of the stocks in the New York Stock Exchange are participating in this rally, is quite high. So most stocks are participating in this rally. I think a lot of that has to do with the quality of the Russell 2000. I think after the June rebalance in 2022, we saw a lot of zombie companies get left out of the Russell 2000, and a lot more stronger companies got added in. I'm not saying that there's not any zombie companies still left. I still think there is. And actually, after this June rebalance, the June 2023 rebalance, I actually think the Russell 2000 will be even stronger of an index. In February and March, we actually might see the New York Stock Exchange and the NASDAQ composite also change as well, too, as a lot of companies get pushed out of those indices, and then some other ones get added in, more stronger companies get added in. And I think that might be the impetus for the New York high-low line to start making that upward trend, as there are stronger components within the New York Stock Exchange and in the NASDAQ. But again, that hasn't happened yet, but I do think that it might happen probably around February, March. So again, those are the two key things that I'm looking at. If we look at the equal weighted S&P 500, it's the same thing. It's on an upward trend. So again, a lot of the this rally is being participated not just by the mega caps, but also the smaller companies as well too. It's a broad participation, a very healthy participation in this market. Okay. So I just wanted to show you guys this. My plans still haven't changed. If I see a big enough pullback, and as long as our liquidity internal market data still remains strong or strengthening, I am planning on buying the dip. I do have some alerts here at 268, 269 zone for the QQQ, as well as the IWM. The IWM, around 171, 172 zone. I am looking to buy some in-the-money leaps, and I'm going to be selling some covered calls against them. Hopefully, we'll be able to capitalize on that. I may miss out on the trade, but it is what it is. I do not want to be chasing this, because for whatever reason, if that inversion trade unwinds, which is a bond trade. So these bond trades, when they unwind, they usually unwind months afterwards. It's not like some small cap stock where, you see like 2-3 days of pump, and then like immediately after that, you see a sell off and unwind. It's not like that. Sometimes, with bond trades and with like inversion trades or spread trades, certain conditions can last for months and months, and then you may not unwind until like weeks or months later. So these are, bond market is a much bigger market, as I've always said. So, imagine like turning around a tugboat versus turning around like an Aframax, a freight container ship. Okay. So yeah, one's going to turn around a lot faster than the other, right? Obviously. So with bonds, it does take a little bit longer for a crowded trade to unwind. So I don't think it's going to happen anytime soon, but when that does happen, there's going to be volatility in the market. You can bet on that. So I don't really want to be chasing it at these levels. I do want as much value out of this as I can get. So I do want to see a big enough pullback where I can buy that dip. And since I'm going to be using leaps, I really wanted to be patient on that, because when you time a leap purchase wrong, I mean, you could be in a severe drawdown for like weeks on end, and that's like the last thing that you would want. So I'm waiting for that value zone. If we get there, and as long as our liquidity internal data is going up, my plan still stands. Okay, so nothing really has changed on my end as far as plans are concerned. Let's take a look at some of our currencies. The dollar, I mean, geez, look at this dollar. This dollar is it doesn't really want to come up now, does it? Okay, I did think that at some point this was going to come back up and retrace. Right now this is the uptrend for 2021 and 2022 in the dollar. I think this is kind of like the line in the sand here at this point. This kind of needs to go up quickly, or if it falls any more, I do think that the dollar, I think that you're going to see even more momentum to the downside on the dollar if we break this level. We'll see. I think that maybe the CPI, maybe the FOMC in 3 weeks. I don't know. I don't know what the oh, look at that. Right here, where the uptrend meets one of our levels, happens right around that FOMC period. So I don't know, maybe it just chops around until here and it breaks one way or another after FOMC. I'm not really sure, but after FOMC, if we don't see a big enough change or a big enough rally in the dollar, I guess I will have to exit my UUP hedges at that point. But I'm going to hold off until FOMC. Maybe after FOMC we get a little bit of a start of the unwind. Maybe. We'll see. Okay, we shall see. Around April or so too, sometimes we see the demand for the dollar go up as foreign companies have to buy dollars in order to pay taxes. That might be the case as well too. Again, I'll take this 1 week at a time to decide what I want to do with my hedges. My hedges are for January 2024, so I do have some time on them. I would like to see these go up, and if it goes up to these levels, that would, I think, make a very compelling buy on some of the precious metal miners that we want to get into. Right now, the precious metals are rallying. I think silver is up today. Let's just take a look at the silver. No, it's actually down today. So silver's down. It was up earlier today. So we're starting to see that. Okay, so maybe we see this coming down. Maybe the precious metals, maybe the precious metals market is front running the dollar going up. I don't know. That I don't know. Yesterday I do know that yesterday a lot of the precious metals did drop, especially silver and I believe platinum. Yeah, platinum and silver dropped, but the dollar still remained mostly flat for most of the day. We'll see what happens, but I do want to get involved in some of the metal miners. I mean, we've talked about some of these names. I know some of you guys, I got a few DMs from some of our viewers, from different social media groups. And, a lot of you guys are hesitant on getting involved with junior miners. I know this word junior because they're smaller companies. And so, you guys, some of you guys expressed some worries in getting involved in junior miners. I mean, junior miners is a riskier part of the market. It just tends to be when metal prices start really going up, and the miners start going up, generally the junior miners will move up faster. Okay, it's like leveraged miners pretty much. Okay, and so I get it. Some of you guys may not want to get involved in a junior miner name. I mean, there's also SIL, which is more the bigger silver miners. The problem though is that the options market is just not as good on SIL as it is in SILJ. If you actually take a look here, Let's see, SILJ. So if you look at SILJ, at least, you see that there's weeklies. It's a much better options market than SIL, for example. SIL has a fraction of the volume and also not as many expirations. If you want to get into like gold, for example, GDX and GDXJ are great ETFs. GDX, I would say, out of all the metal mining ETFs, out of all the precious metals mining ETFs, GDX is probably the most liquid. GDXJ is also decent, but SILJ is actually, I think, a little bit better when it comes to, it's just a tad better when it comes to the actual options volume. From my memory. Of course, you can check at the end of the day. Right now, we're filming this live about 30 minutes to an hour after the opening bell. So that's why you're not seeing that big of an options volume in this yet. Yeah, generally the option volume will start coming in as the day progresses. But if you guys are worried about liquidity and everything like that, I mean, GDX would be the way to go. And some of the individual names are also good as well too, like Barrick Gold. Barrick Gold is one of the big dogs of gold mining. Barrick Gold is one. Also Newmont is another one that you could use as well too as a proxy. I like Barrick Gold a little bit better than Newmont myself, if you're going to go with the individual names. Barrick Gold also is in copper. I believe they do silver as well. Don't quote me on that, but I think Barrick Gold does gold, copper, and I think also some platinum and palladium metals as well too. But mostly, of course, it's gold. But that's a good miner to be in. I just like the ETFs better, just because gold, the precious metal mining in general tends to be very. There's just a lot of drama in it. Sometimes they get into these disputes over land rights, mining rights. They get disputes with local governments, environmental groups and things like that. And so there tends to be a lot of drama within individual precious metal miners. And so that's why I tend to like the ETFs more. And again, the ETF that I'm going to try to get into is SILJ, which is the junior silver miners. And hopefully we get an opportunity to get in on that. So I just wanted to address that as some of you have DM'd me about this. So if junior miners is not your thing, you can always go with GDX with the gold miners, the more senior gold miners, or you can do individual names like Gold, Barrick Gold, or Newmont. So those are some of your options that you could use. Okay. Crypto. The last thing I want to get into is crypto. So crypto, the open interest on the Ethereum options market is increasing. It is increasing, but it's just not there yet. It's not there yet in order for me to take a look at that to see what pressures there may be based on options positioning on the actual physical Ethereum price. My plans still haven't changed. Yesterday, I put out a plan on what I plan on, what my plans were in buying Ethereum. And again, I added a new plan. So most of my buying, I'm still going to do it on this Ethereum to gold ratio line. All right, this red line right here, this orange line is where my alert is. But this red uptrending line that we drew from 2020, the uptrend line, that is where I am going to do most of my Ethereum buying. At around right now, it's at 0.59. It'll be at 0.6 by next month. So Ethereum gold ratio at 0.59 to 0.6. But I will do an entry level buy if we can get to this uptrend line. Okay, getting to this uptrend, this is the uptrend line from 2020 to 2021 Ethereum priced in dollars. If it can touch that, it would create a higher high on the daily chart, and then if it pulls back from there and hits this 1241.46, that on that first touch, that's where I'm gonna buy. Okay, I am gonna buy right there at 1241.46, but again, it has to touch this line and then come back down. If the Ethereum line does not touch that line, and if it just pulls back from here, all right, Actually, I think it on a closing basis, it already did make a higher high. So I mean, you know, in that case, I might just buy a very, very small, much smaller amount than the initial buy. My initial buy is already small to begin with, but I might even buy even smaller if it just pulls back from here, from there. I really wanted to touch this line, make that clear higher high, and then come back down and touch 1241.46. That would be high value for me. Okay, so that's what I'm looking for. And again, this is the initial buy. My main buying still hasn't changed. It's still the Ethereum gold line. This is the line that we've been looking at since all of 2022. It still is not there yet. I mean, is it possible that the Ethereum gold ratio just chops around here until this uptrend line meets it? Very possible. In that case, we're looking at more like this might happen around May or June of 2023. Okay, if it just chops around at these levels and just stays flat, if Ethereum gold just stays flat by May or June, we're going to hit that upward ETH gold uptrend line. Okay, so that's very possible. I'll be patient. I'm willing to be patient. Patience and discipline. Okay, patience and discipline always. So I'm willing to be patient, and I will. My plans for my major buy in Ethereum still hasn't changed yet. All right. Anything you guys want to look at? Anything you guys want to look at? Going once. Going twice. All right, then. In that case, we'll wrap up our session of the morning market memo. Our Discord invitation link is in the video description below. Come join our Discord. Be a part of our growing community. There's no sub fees, no paywalls. Of the people, by the people, for the people. And if you enjoyed our video, hit like, follow, subscribe, comment. Show us some love, baby. All right, I'm going to be back tomorrow, 30 minutes after the opening bell of New York Stock Exchange, 10 a.m. Eastern Time. Hope you guys have a wonderful day. Trade safe.